If you buy a property for $100,000 and you sell it any time later, or more than a year, for $200,000, then normally you'd have to pay what's called capital gains tax. In other words, you've made a profit, bought it for 100, sold it for 200, you'd pay tax on that $100,000 worth of profit. And let's say the tax is 20% of the profit, so you would only net 180,000. You'd have 180 to invest. Whereas a 1031 exchange is where they say, okay, it's gone up in value to 200, you've sold it for that, but if you're going to transfer your investment, your $200,000 investment in this property you're selling into a new property that you're buying, we'll let you defer the tax until you sell that second property. And by the way, when you do sell that second property, you can do another 1030, so you can roll them over. So it's a way of deferring the tax because you're basically putting your profit in the first property into the next one and so on until you ultimately sell. So it's a very smart thing to do.
You know what, Dolph? You're 100% right. And absolutely, if you've got investment property and you're looking to buy more investment property, don't sell it and take the capital gains hit. Roll it over in a 1031 exchange. You can do that multiple times. In fact, at some point, if you have enough equity in there and you want to pull it out, just do a cash out refinance, pull it out. You don't pay tax on that, and you can recapitalize. But the one thing to note that's a little different is if it's your primary residence and you have lived in the property for at least 2 out of the last 5 years, you can have an exemption of $250,000 per person, meaning if you're a couple with a spouse, it's $500,000, and you can take that and keep that profit and not have to pay tax on it. So great advice.